Welcome to SB Talks. Today is Wednesday, May 1st, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Today we have a special edition of SB Talks where we'll be delving into Nick's recent fixed income review. In addition to that, we'll be talking about the outlook for Australian interest rates given recent inflation numbers and some discussion of the risk of a rate hike here, as well as the US economic picture, their inflation challenges, and tonight's Federal Reserve meeting. Now, Nick, our core focus today will be the bit of discussion of your recent fixed income review, but there's been a lot of speculation in recent weeks and in the last few days in particular that the interest rate outlook in Australia may be substantially shifting. We saw inflation numbers last week that were hotter than expected, certainly hotter than desired, and has led some commentators to suggest the RBA might not even be done on rate rises yet. What's your take, I guess, not just on the number, but on the broader economic situation and your view on where we may be heading with interest rates here in Australia?
Yeah, so last week we got the first quarter CPI numbers for Australia, which are the official ones. We get the monthly ones, but they only give us a partial guide. And the number that we focus on, the trimmed mean measure of inflation or underlying inflation, was 1% for the quarter. And that compared with 0.8 in the prior quarter, so it was an acceleration.
Which on an annualized basis puts us into the fours.
Yeah, so year on year was 4. That was down slightly from the prior quarter, 4.2, but it's not the progress that the RBA is really looking for.
We'd be wanting the quarterly numbers to really be getting well down beneath 1 or into the 0 point, ideally 0.6.
0.6, 0.2 per month, that sort of thing. So...
What's driving it?
Yeah, so it's services, and we've spoken about this on the podcast before. Services are obviously more sticky. They're tied into, the strength of the labour market. In this particular quarter, there was a few sort of things that sort of reset at the start of the year. So things like childcare, education costs, that went up quite a lot at the start of the year. Pharmaceutical, there's some government regulation around some of those things. And
timing of when things go up a notch.
So service inflation went from about 1% over the quarter to 1.4%. So that was really a big part of the acceleration. Goods prices was fairly steady at around 0.5% for the quarter. So it's really that services inflation
which is wage inflation making up a large component of that. Yeah,
there's wages, and then there's, government regulations and subsidies and things like that also have a bit of an impact. So that these things just take longer to come down, So I think for the RBA, it would probably not be necessarily of immediate concern, but it just maybe means that they need to tweak their forecasts for how quickly inflation comes down. So I've seen some forecasts, for example, say inflation at the end of the year will go from, instead of being 2.7, more like 3. So that's really...
That's probably the best we can hope for, you'd have to suggest, given where we sit today.
So we've seen the rate market reprice. We now have 8 basis points of rate rises by August. So what's that, about a quarter of a chance of a rate rise, 25% chance of a rate rise by August.
To the listeners that aren't as familiar with this or look at it every day than you, the market's not necessarily automatically saying that we're going to go up by 8 basis points. It's just trying to suggest how likely are we to be higher by then than we are today. And it says there's a slight chance that we might be higher by then, but not huge.
Yeah. I mean, there is one commentator that's come out and said they think they need 3 more rate rises in Australia, and we need.
What's your take on that?
I mean, look,
inflation is certainly sticky, and it's taking its time to work its way through the system, but there's other weakness in our economy.
Yeah. So yesterday we got retail sales for March. And it was down 0.4%, and some say, that's a reversal of the strong numbers in February. Where Taylor Swift came out, and so there was all that spending on merchandise and hotels and all that sort of stuff. But February's numbers were actually revised down. So
are you calling this the Taylor Swift hangover?
I think it's Taylor Swift reversal. It's a reversal of the Taylor Swift effect. But if you strip out spending on food, retail sales were down 1.3% for the month, and they're basically flat over the last year. Now there is still goods inflation in the system. So that just really shows that
the level of sales is going backwards.
Volume of sales is going backwards.
And that would be consistent with what we've seen in sort of reporting season here in Australia, where consumer discretionary has been pretty weak, and even elements of luxury have sort of really shown that people are pulling back on their spending in a notable way now.
Yeah, absolutely. And we've spoken on the podcast before about, I think it's 3 quarters in a row now where consumption, or GDP growth per capita has been negative. And the consumer has really not contributed at all, and so retail sales continue to show that trend is still ongoing.
So then it's almost like we've got a barbell situation here for the RBA to consider, where there's consumer weakness, there's definite weakness, more than pockets of weakness in the economy, but we still have this sticky inflation, and they're trying to figure out, well, how do you move the big blunt lever of interest rates?
Yeah, and that's why I think some people are suggesting that maybe another rate rise is needed. So I wouldn't completely rule it out.
What's your base case? Would you be in that camp?
Yeah, possibly.
One more rise?
I think they'd probably wait for another strong quarterly print before pulling the trigger on that. I think they probably wouldn't act today or this, in the next meeting. But I certainly. Yeah, I wouldn't rule it out. But I think rate cuts are definitely off the table.
I was going to say more than the one more rise. It's what it is really telling you is anyone that was getting excited about 1, 2, 3 rate cuts into the back end of the year needs to wave goodbye to that unless we see something really dramatically fall off in the economy.
Yeah, and I think the property market, so we got the April property prices out today, another 0.6% monthly rise. I think that takes year-on-year rises to 9.4%, because I think a lot of people were believing that rate cuts were coming, or they could see them over the horizon.
Pricing them into their own calculations.
Pricing them into, when they go to bid on properties at auction. So I think it's a difficult situation for the RBA. We talk on this podcast about the narrow path that they have to tread, and I think it just got narrower.
A similar story playing out in the US as well. Again, the Fed meeting tonight, I believe, and they are facing again some sticky inflation there, and the market started to substantially reevaluate the likelihood of rate cuts there, or particularly the timing and pace of rate cuts there, and that's seen the equity market really pull back from some of its hot runs since October, since this sort of rate cut speculation began.
Yeah, so we had that hotter than expected March CPI print that came in at 0.4% when everyone was hoping for 0.3%, and then overnight we got the first quarter employment cost index, which is their version of wages measure that's probably more accurate than the average hourly earnings that comes out every month. And that was also hotter than expected. So wages in the US grew 1.2%. So wages and benefits, because we combine them, 1.2% for the quarter, versus 1% expected and 0.9% the prior quarter. So an acceleration in wage pressures. Big part of that was people that work for unions. So anyone that worked for a union got a 1.6% quarterly rise. So that's certainly bumped it up, and to the extent that would be repeated is probably less likely. I think those sort of negotiations occur less frequently.
But it's still it's 1.6 there that the system has to sustain, and it trickles its way forward. It just makes it harder to get the inflation genie back in the bottle.
Yeah, it's the same story as here. Services really the big driver of that. Car insurance was the big driver in March in the CPI numbers. And some of those things, just they're lagged effects. They take a while for kind of flow into prices and then flow out of prices. So I still think that the general disinflation story is intact. It's just going to take longer. We've spoken about the last mile being harder to cross. So I think definitely that is playing out.
Has that influenced your thinking with regard to US rate outlook much? And just to reiterate, you'd always been sort of more cautious about the timing and pace at which they cut rates.
Yeah. So now, we at the start of the year, we were looking at 6.5 rate cuts priced in for 2024.
So the market expectation was 6.5, not necessarily our view.
No. Yeah. And we're now just about 1.
Right.
Just a tad over 1 by December.
A Christmas cut. Yeah.
Yeah. So really the market's kind of really backed away from the view that the Fed is likely to cut this year. I think there's still a possibility. It just depends on how long this sort of last mile, this service inflation takes to leave the system.
And again, the only thing that probably dramatically changes that position is if the US economy starts to go backwards in a significant way, which to this point it's not.
No, it hasn't. Although the first quarter advanced GDP reading was a bit softer than expected. The consumer is still doing a lot better there than here. So consumer spending grew 2.5% annualized in the first quarter, which is pretty good.
And I think a lot of our households are a lot more exposed to interest rate impact than the US household, given the nature of their long-term mortgages. Yeah.
Absolutely. In Europe, things are a bit different. They're actually, their inflation is coming down. It fell from 1.1% for the month to 0.7 in April, and so the ECB looks likely to cut rates in June. So very different speeds at which inflation is being, is coming down in different parts of the world.
And US earnings season, so it seems to be a never-ending treadmill. You're only just done before you start again.
That's right.
Anything of note? Anything catching your attention in that?
Obviously, the focus is on the Magnificent Seven.
Can they justify their growth and valuation?
And they continue to beat expectations. So we had Amazon last night. They reported earnings of 98 cents for the quarter versus 83 expected. So quite a big beat there. Profits tripled. Really the AI theme continues to drive them. They're actually going to ramp up a lot of capital spending this quarter just to try and get ahead of all this AI spending. So I think the story there is pretty good. Microsoft, Meta, Alphabet, all pretty good results as well. So generally, earnings continue to be better than expected.
No consumer warning signs there of great substance.
And I think, despite, a little bit of weakness in the equity markets, people are probably more focused now on earnings and less focused on rates.
Possibly a little bit of just stock taking and rationalization after the strong run that the equity market had over that sort of October to March period anyway.
Yeah.
We'd probably welcome that.
Yeah, I did write about that in the latest quarterly, that I thought there'd be a period of consolidation, a possible pullback, and we have seen a bit of that.
Let's jump into now your recent review of the fixed income and cash sector, and I might like to get you to start by setting out for the listeners some of the main levers that you have in your hands when looking at this space in terms of things like considerations around government debt versus corporate, fixed versus floating, Australian versus international. Talk us through, I guess, how you look at a high level down at the options in this space.
Yeah, so when we redid our asset allocation last year, we have obviously cash, Aussie debt, global debt at a high level, but kind of the next level down, we actually have, I think it's 7 sub-asset class. So we've got cash, we've got floating rate Australian debt, we've got fixed rate Australian debt. We've got global aggregate bonds, which sort of like a catch-all. We also have investment grade corporate debt, high yield bonds, and leveraged loans. So they're all the little building blocks that we also have within portfolios. So as part of the fixed income review, I wanted to look at those blocks and to make sure that we had funds or ETFs in each of those categories that would allow us to move, as you say, between fixed and floating, government bonds, corporate bonds, investment grade, high yield, etc. So it just gives us more tools.
So it doesn't mean that you're necessarily using all those blocks today. You have got them sort of in your toolkit to use should you feel that better value starts to open up in some of those spaces.
Yeah, that's right. And also I think, in the past maybe we would have allocated just to a global fixed income manager and say you go away and work out kind of where you think the best opportunities lie. This allows us to maybe take some of that decision making back off them in-house and to make the decision, okay, we want to be more, take on more risk, so we'll go into lower quality corporate debt with a higher yield, or we want to take on less risk and go more into government bonds. So it just allows us to kind of align our fixed income allocations with our macro views of where we are in the economy.
And in terms of your strategic asset allocation, what is your default starting point in terms of how much mix you would like into things like, say, traditional government longer dated duration interest rate duration bonds versus corporate floating credit? And I say that because fixed income, let's call it the traditional bond, has been a bit of an unloved space over the last couple of years when interest rates rapidly went from zero back to normality, and that saw investors wear capital impact on those. How comfortable do you feel today jumping into that space or increasing allocations to that space, given where we sit with interest rates and the outlook and the inflation discussion that we've just had on this podcast already?
Yeah, so you might recall, we moved to a neutral position in fixed rate bonds back in sort of September, October of last year. So we're broadly neutral in that space. And we still believe that fixed rate government bonds have an important role to play in portfolios. In a recession, there is really nothing else that goes up in value like a government bond does. So you need that to protect portfolios.
So that's there as the insurance policy for tough times, but the insurance policy only pays out if you've got an interest rate level that it can drop from to, that you get an instant capital hit.
Yeah, and we think, sort of notionally, where do we see the neutral rate, over time? It's neither speeding up or slowing down the economy. And we think, it's hard to know with precision where that might be, but say it's between 3 and 3.5%, and we've got bond yields, between 4 and 5 now. So there's a buffer there where rates could come down, over time as inflation comes down and provide a capital benefit to portfolios.
Yeah, so when people worry about the black swan event or something that's the unforeseen hit to the economy, this is really your bumper bar put in place for that, and you're happy to allocate that and definitely see good value in it at present over the long term.
That's right. And I think also, there are other features of fixed rate bonds that, provide returns. One is what they call, the shape of the yield curve. So under a normal scenario, you should get paid more for owning a 10-year bond versus a 2-year bond because of the risk and the uncertainty and all that sort of stuff.
So 10 years to get your money back from the issuer, maybe a corporate, maybe a government. You should get paid more for carrying that credit risk for 10 years. Yeah, that makes sense.
That's right, and the economic uncertainty. So that they call that the term premium. So you should earn something from that, normally. So that's why you'd like a fixed rate bond over a floating rate, and also, over the past 30 years. Everyone was wrong about where bond yields would go, and they fell. We're in a disinflationary environment, and so you were always better off being in fixed rate bonds than floating rate bonds in that prior 30 years.
So we're talking about the sort of the 1970s, early 80s, 90s through then that big decline in rates from there through
up to COVID.
Up to COVID.
Yeah,
when they actually post-COVID, really, when they had to get back to reality.
When they went to zero. Yeah. So you had 30 years of falling bond yields, and that meant that bond prices went up generally, and you did better than fixed floating rate.
No, you're not foreshadowing that we're heading back to zero, but you're saying given the rate that we're able to buy at and get paid today, there is probably margin, certainly plenty of margin for them to come down if the economies get weaker. Therefore, the case is they have their place in the portfolio. And what would you have in that bucket now, and some of the types of assets that you would hold within there?
Yeah,
both in terms of domestic and global.
So the changes we've made are sort of a barbell approach. So we've got very high quality government bonds to provide that protection and that interest rate duration. In portfolios. And then we also have sort of more corporate risk, which, high yield bonds, corporate bonds. So we sort of have split between the two, as I could call it, a barbell approach. High quality and higher return, but higher risk.
So again, examples of your exposure domestically versus internationally in that government space, and then maybe for the benefit of the listeners, a bit of a feel for what might sit in that corporate bucket.
Yeah, so with our cash allocation, we're taking on a little bit more risk in cash, getting another 40 to 50 basis points of yield out of that. But we think we've done that in a way that really doesn't move too much away from what cash should be, which is a provider of capital stability and liquidity. We in our sort of floating rate bond exposure, we have a very high quality portfolio of about 150 bonds, AA minus, so similar to the big banks in Australia, credit rating wise. Floating rate, high quality, a large number of issuers.
Yeah, it's a very high degree of diversification.
High degree of diversification, good credit quality, and low volatility in a kind of, a risk-off event.
What sort of yield are you expecting to be able to generate from that in the current environment?
That's over 5% at the moment. So, that's 70, 80, 90 basis points above where the cash rate is today. And then in Aussie bonds, where the index is 93% government and government related, and what we've decided to do is sort of tilt more towards corporate credit, but still retain about 5 years of interest rate duration. Still very high quality portfolios, similar credit ratings to the floating rate one I just mentioned, sort of that AA, single A kind of level. But we get a 90 basis point pickup in yield for doing that. So taking a little bit more risk, but still got interest rate duration, which we want. But there's less government exposure there. And then in global fixed income, we've got quite a big allocation to just pure government bonds. So that gives us that safety element. And then we've also allocated a little bit to high yield bonds, which are paying 9% yields at the moment.
So 9% yield, that sounds great. Obviously, that comes with certain risks. Maybe explain what type of the underlying assets that sit in that portfolio and why you are comfortable with it.
So these are sub-investment grade. So these are borrowers that have taken on more debt. They've got a more leveraged capital structure, global. And the typical spread over what you would get from a government bond is around 350 basis points to 400 basis points. So you're getting a big income pickup, but there's obviously a higher risk of default. So we think that if the economies kind of hold together as we envisage, the default rate shouldn't lift too much. It should, it'll go off the lows that we saw sort of in the COVID and post-COVID period, but back to more normal levels around 3 to 4% annual default rate, which is sort of the long-term average.
And we're, I guess, using managers there that we hope are able to generate a lower default rate through their expertise and their history than that.
We've done a lot of work on the manager and found a manager that we're very comfortable with. They've been around for about 25 years, very low defaults, and they've got a good team at hopefully picking the ones that don't default and continue to pay those high yields.
So you're getting yourself quite comfortable with the risk-adjusted return in that.
Yeah, I mean, I think at 9%, some people say that's like similar to equities, right? And to some degree, I do think of high yield bonds as a equity replacement. It does move with equities. It's corporate risk. If people worry about the economy, they worry about high yield bonds as well as equities. So those things can be more volatile. But as I said, we have it balanced with high quality government bonds also in the same sleeve, if you like. So on a blended basis, we hope that it can, do better. But if we do get more concerned about downside risks, then we'll decrease that and increase the government bond exposure.
The ability to dial that back. Anything that you've not allocated to the portfolio that you otherwise might have liked to, just because you didn't feel that there was value in it at present, or?
Yeah, so we don't have a lot in corporate bonds at the moment. The spreads there are pretty tight.
So the premium that you're getting paid for that is just not enough to justify the risk.
Yeah, and also I think, you investment grade bonds, we have that in Australia, as I mentioned, but we haven't gone heavily into that for the global exposure just because of tight spreads, and we've got that effectively with high yield bonds, so it's all part of the portfolio construction process. There was no additional value in adding corporate bonds, but then, as I said, if we wanted to de-risk, we might take money out of high yield and go into investment grade as a way of getting there.
A lot of levers that can be pulled and adjusted as the economic situation unfolds.
Yeah.
All right, excellent, Nick. very thorough run through, not just on the fixed income, but on the world as we see it today. So thank you very much for your time, and thank you to all our listeners. We will speak again soon. Take care.